So, Akhil, a question I get asked a lot of the time is, do they apply a mortgage under interest only or as a repayment mortgage? What do you recommend and why?
It's a great question, and you said you get it a lot, and I get it a lot too. And there's no right or wrong. But what I would say is the vast majority of our applicants, our buy-to-let borrowers, purchase property in an on an interest only basis, and the simple reason is because of cash flow. Bearing in mind, for those of you that are moving into buy-to-lets or wanting to become a first-time landlord, what's the difference between an interest only and repayment mortgage? And the key here is if you're repaying the mortgage on an interest only basis, all you're doing is you're paying back the interest costs that are owed because you borrow the money. But at the end of the term, whether that's 20 years or 25 years, the debt will remain there. So if you borrow 100,000 and your interest only payments are £100 a month, you still owe the bank £100,000 in year 25. However, if you want to repay the mortgage on a repayment basis, also known as capital and interest, what you're doing is you're paying off the debt, the money borrowed, and the interest over the term of the mortgage. So most clients do purchase property in a buy-to-let capacity and have an interest-only basis for cash flow purposes. So they have more surplus income in order to reinvest into real estate property. There is a small percentage that do purchase buy-to-let in a repayment strategy in order to pay off the debt as well as the interest. So it's horses for courses. For those portfolio landlords that are seasoned investors, got large portfolios, you may want to have a hybrid structure. You might want to have a few properties that are interest only and some are repayment. So these are just some ideas that you might want to start thinking about, because eventually the terms will come up and you'll need to repay the debt. So it's either by sale of the security property or it's having a vehicle to repay the loan.
So from the interest only, let's go into that a bit more detail if possible. So they pay the interest,
Yeah.
The mortgage still remains. How much do they have that they can pay on top of that on an annual basis?
Sure.
Is it 10%?
Yeah, most lenders do offer a 10% overpayment of the mortgage balance. So yes, you are right. Most lenders do offer a 10% overpayment, which is nice because that pays off, that reduces the debt down as well. So if you split that 10% over 25 years, that does help reduce the debt that you owe at the end of term.
Which would be far cheaper than doing a repayment mortgage as such, where you pay the full amount off, but you still use the cash flow from the interest only.
Yeah, and it's another great, sort of a strategy to pay down the debt as well as have great cash flow as well. And with the repayment strategy, it means that your sums are fixed each month. Whereas if you've got the interest only, you can overpay 10% as in when you want. So you might want to pay it in month 1 or you might want to pay it in month 6. It's totally up to you.